team. Even I can trade back here again for another video. Today I am going to try to focus on trying to keep things more condensed. I noticed my videos are a little bit longer probably because I ramble and say a lot of ums and uhs, so I'm going to try to watch out for that. Keep it a little bit shorter this time. This video, I want to go over a few things. First of all, my updated trading system, just to review what I do now, what lessons have I learned, how am I implementing what I've learned, what do I do differently than what you've probably seen in the past. Also, I want to talk about a few of the items that I follow to help me make trade decisions. And I want to review my September and October trades so we can kind of see. I started tracking them a little bit differently, a little bit more visually to my liking. So I want to share that with everybody as well to see if maybe you like that as well. And I'm going to be using TradingView, which you can see on the screen, to do all of that. So before I get into it, I want to make sure that I ask everyone that is hearing the sound of my voice, please subscribe to the channel, leave a comment below with any questions, anything that you can think of that you want to say, feedback, cuss me out, whatever, say I'm an idiot. Say something down there for the algorithm, because the algorithm is dependent on activity. So the more activity, the more it's going to show to more people. For every comment, it shows this video to 10 new people who could use this information and maybe change their lives. So please leave a comment, like the video, interact with the video in some type of way. Let YouTube know that you're here and you're engaged in the content. It will help me out tremendously to keep making this content, so I feel like somebody's actually there. Anyway, let's get into it. So I want to talk about my updated trade system. So basically, point by point, the major thrust of it, the big thing is to use half or less of your available cash that you have in your trading account. That probably sounds like a lot more than you've probably heard, but I am more geared to smaller accounts at this current point. So we're talking about 25,000 or less. And you don't want to be sitting there forever making $5 a day. And with a smaller amount, I personally feel as though you can be more risky with a smaller amount because it's much easier to replace than a larger amount. You can go back to work, you can save, or I can, whatever, depending on your situation. But I will not go over half of the cash that I have in my account. I don't care how much it is, if it's $2,000, whatever. I'm not going to use more than half, and there's specific reasons for that. And I'll get into that later. I use technical analysis for my order entry, and you can find those details on my Discord, which I forgot to plug. By the way, that link is going to be down in the description of this video. Please click on the link, join the Discord, join the discussion. I have all of these details as far as my full trading system listed there. But technical analysis, as far as using the stochastics to judge an entry, do I want to enter on the call side or the put side? What time do I want to time the market as far as entry? Do I think the market is oversold, overbought, whatever? I use the stochastics. I use the pivot points, as you can see right here. I use market pricing as far as looking for measured moves and things of that nature. Candlestick pricing, all of those techniques to decide on a proper entry place, because you don't want to enter the wrong side of the market at the wrong time if you can help it. So I use that. I pretty much only do 1 DTEs at this point instead of 0 DTEs. And that boils down to the math of where I like to trade. So the delta I like to trade at, you're usually getting 10, 15, or 20 cents. And I find 20 cents is where I really like to be as far as receiving a credit for my spread at a 5-wide spread. And 20 cents is much easier to get on a 1 DTE as far as a safety level that I feel is a good distance away from the market versus a 0 DTE same day trade. And it works out to be essentially the same as 0 DTEs the way that I do it, because I'm hopscotching my account every day. So I use half of my account for a one, let's say tomorrow, I use half of my account for a 1 DTE that expires tomorrow. Then when tomorrow comes and that trade looks like it's going to be successful, it's all done, I'm pretty comfortable with where it's at, then I use the other side of my account to place a new 1 DTE. So effectively, I have an expiration every day anyway. And instead of getting the 10 or 15 cents that I would get for a 0 DTE trade, I'm getting 20 cents for a 1 DTE that I'm able to maintain using that technique. So mainly 1 DTEs at this point. I always put on stops now. Always put on stops. And that was a very painful lesson. You saw my last video if you're here. So you can see exactly why, but I always put on stops. I usually do a 3x stop on 20 cents, even if the trade is less than 20 cents, typically because I'm usually doing an iron condor and I've got that much coming in anyway. So it's usually about 60 cents that I put on my stop for. No trading on Fed day. No trading on Fed day. That's another hard lesson that really the market had to teach my hard head to get it through my skull. No trading on Fed day. So today happened to be a Fed day. Did not place a 1 DTE yesterday. My account was clean. Fed day happened. The announcement happened. The market did what it did. I let it do what it was going to do. And of course it went bananas and went crazy. You can see my little X guy there is like, nope, nope, nope. And the market decided to go up, then it decided to go down, then it decided to go up again. And that's where it kind of settled out. And I did place a trade right before the bell, probably about 5-10 minutes before the bell, once I felt like the market had figured out what it wanted to do for the day. So this is a 1 DTE that will expire tomorrow. So no trading on Fed day. Clean, right? Just don't do it. Don't do it. Let me see. I roll on a case-by-case basis. So the way that I choose to roll currently is if I get stopped out, I'm going to get stopped out for about somewhere between 60 and 75 cents. At that time, I'll look and judge, do I want to enter the market at that point for a roll? I may not enter the roll right then and there. Usually people enter a roll as one order. I don't see a reason to do that. The dollars are the same whether you roll at the same time or you wait. I choose to wait for the market to come to a level that I'm comfortable with. Usually if I'm getting stopped out, the market is, either crashing or it's going haywire in some direction and I don't have a good read on what the market is doing. So I'm usually going to wait. And I have an example of that we can go back and look at as well. So I'll show you a successful roll that just happened a couple days ago. And lastly, my latest thing is I really don't chase specific return goals or amount of contract goals as much as I used to. Those numbers are still in the back of my mind, but I feel as though having those numbers front and center cloud my judgment, because sometimes I'm not as confident in a trade as I am other times, and I really want to do reduced contracts or go for less premium or something like that. I now let the market determine how heavy I go after a particular trade versus a particular goal that I want to hit for that day or that week or that month or whatever. Like before, my videos before, I was like, you double or not double, but increase your contract size once you hit an excess profit amount of X amount of dollars and everything like that. Well, I found what that did to my mindset is I felt kind of trapped by those goals. Like I had to hit this particular goal that I set out to hit. And that could cause me to hit the trade earlier than I should have or would have otherwise, or put in more contracts than maybe I felt comfortable with otherwise if I wasn't thinking about it. It just kind of pinned me up against the wall. Like have I have a goal that I need to hit and I need to hit it. So I'm going to that was front of mind versus, okay, what the market is telling me is this, so let me be a little bit more careful here. Let me put in less money, less risk, less whatever, versus, okay, it's Friday, I need to be at X amount of dollars or X amount of contracts by Monday. So I reverse that and just let the market kind of tell me what it's going to do. And then I'll take a step back, maybe after the week or after a couple of weeks, and say, okay, do I want to increase my overall contracts, my average contracts now, or do I want to keep it the same, or do I want to lessen it? If I really feel like I can't get a good read on the market overall, I'll just lessen my contracts overall or trade with maybe a quarter of the account or something like that until I feel like I have a better read on what the market is doing. So market-based kind of contract picking and profit driven and all that kind of stuff, just kind of taking what I feel like the market is giving me at that particular point. Because I know at the end of the day, it's all going to work out in the wash. And percentage wise, these trades make so much money that I'll be just fine. I'll be much better by being careful with the trades than I will be being systematic with the trades. So those are the changes that I've made to the system. As far as macro economics of what I'm looking at, which I don't think I've talked about before. On the right hand side, you can see my watch list, and this is all through TradingView. All of this stuff, I'm gonna go over what all these lines and stuff mean in a second, but through TradingView, they give you one watch list that you can use if you're on the free plan. I'm on the free plan, and apparently they've reduced the amount of stuff that you can watch. So I've got more stuff up in here than you'll probably be able to get, because every time I delete something, I can't add it back. So I have to keep what I have. So basically what I watch is the indexes, the SPX index, the 10-year treasury yield, because this is really, really big right now. So every time this pops, the market is probably going to be red. The dollar is always a big thing in the market. So dollar goes down, market goes up in general, not all the time. Oil, and this I am going to keep for the long term. I have this in my retirement accounts. This is I just feel like if you're going to be trading or investing in the long run, you got to have some oil, because oil is the only thing that for sure is going to go up over time, because it's a limited resource and we won't stop using it, can't stop using it. So I don't care if I have to give this to my great grandkids. This is going to go up and up over time and get more and more valuable. So I'm going to hold on to it. The futures right here. So I got to keep track of where the futures are, and the VIX, of course. So everything else is kind of stuff that I've just picked up over time or interested in over time or whatever, just to follow it, kind of get a read on the overall markets. So that's my macro stuff. Now let's review some trades and see how our last 2 months have been since I started tracking it in this visual way. So let me first give you a rundown on what all these lines and everything mean. So what I started doing, I found a nice little tool in TradingView that gives you a parabolic curve when you use it. And this closely mimics how time decay works on an option. So if you've ever seen a risk graph on an option or anything like that, you're going to see a parabolic line on both sides of it that shows how the further out it gets, the straighter it gets. But when it's very close, it curves. You might have seen it as on the opposite way as an option gets closer to zero, how time decay comes out faster and faster until it's basically comes out super fast like a waterfall on the end. This is the reverse of that, but it works very similarly. So what I started doing a long time ago is just a straight line from here to where my strike price was to kind of show the risk level and where I might want to exit, and if it's getting close to the point where I want to exit. But the thing about a straight line is a dumb line because it doesn't reflect that curvature that happens with theta decay. Well, this line does, and it's not perfect, but it's very, very good because when I'm tracking a trade and I see it getting close to this curved line, it's usually right on the line where it wants to get stopped out. So this is what that line represents to me, is the line where this trade wants to get stopped out or getting close to being stopped out. And I can tell you that this line, if you draw it right, it is very, very representative of your stop out line. So you can kind of visually see how close you are to getting popped out of the trade. Okay. So that's what this blue line is. The blue line starts at the time and place where I place the trade, and it ends on the expiration time at my strike price. Okay. So above for this particular one that I'm looking at is a call spread above the market, and this purple line is my strike price, and it shows where the strike price kind of begins, where I place the trade, and it ends on the expiration. So it forms like kind of like a little seven, like a little seven looking thing when it's on the top side. On the put side, of course, it's going to be the opposite, right? Going to be the opposite. So when you see all these blue curved lines and these purple lines, that's what that means. This is showing my kind of risk and time frame for that particular trade and where the strike price is for that particular trade. Now the blue lines represent where they went to expiration. They just expired worthless. Green lines represent where I closed it early for a profit. Orange lines represent a roll. They represent a roll. So this particular trade I got stopped out of and rolled it, decided that was a good time in the market to go ahead and just roll it down, roll it forward or whatever. And I did roll it, and it ended up being successful. So the orange lines are a roll, and then obviously red lines, which don't have too many, but red lines represent just being just stopped out. Didn't roll it or anything like that. And this yellow line, I think I closed it for scratch maybe. It wasn't a loss. It wasn't a gain. It was just closed, I think. So, yeah. So let's go back and take a look. So I started tracking this way right around here. So right around early September. So you can see all the trades. I do this for every single trade that I do. So you see all the trades. Now these other lines, like this red line right here, this is just a trend line. Okay. So there's probably another one down here, another one right there, just a trend line. Okay. So that's all it is. It's just long-term trend. But you can see this gives you a really good representation of where I trade at, how my trades perform over time. You just kind of look at it and see how close the market has gotten to my trades. Now these are all, not almost all 1 DTE trades. Not all. Like this one is a 1 DTE, place the trade late in the day. This is a 0 DTE right here. It's still fine. 1 DTE, 0 DTE, 1 DTE, 1 DTE. So one thing that I hear about 1 DTEs and overnight stuff is that overnight risk, which yes, there is overnight risk. Like for example, if I placed a put trade right here, I probably wouldn't have been happy just depending on how far away I got. Um, but overall, I don't find that overnight risk to really keep me up at night. Um, I don't remember a time or a trade recently where I got caught with my pants down on a 1 DTE except for Fed Day. Except for Fed Day. Like these days right here, all these reds, this was just a hard, this was a nightmare. So let's zoom in onto this because I want to show you guys. This is right around Fed Day. This is like mid late September. Okay. So I don't even know what this was or if this this line should even be there, but this I guess I don't even think this line should be there. So I'm just gonna ignore that because it doesn't even look right. This day started the foolishness. Okay. So what I did here is this was supposed to be the start of a long-term trade that I was doing for people that just don't have time to deal with the markets on a day-to-day basis, can't watch it all the time, so on and so forth. So this day, I just put in a contract for, maybe like a week-long trade or something like that, a couple days, trying to get people into, that just can't do the daily stuff. Then I also did, a 0 DTE that day as well to make that money for the day. That was fine. So everything really this day ended up fine that particular day. But I did it right before Fed Day. So this is Fed Day. You can see the characteristic 2 o'clock foolishness happen right here. And the market decided it really didn't like what Jerome had to say that day. So it tanked and tanked and tanked and tanked and set the market up on just a downward rip for a little while. Now all my calls expired just fine, obviously. So that's fine. That's up in the stratosphere. No worries there. But the tanking market took out like 3 of my trades. Now it took out my long-term trade right here, the day after Fed Day. Now this is that time where overnight was a worry, but again, Fed Day. So we closed right around here and the market opened up, tanked again, and just continued to tank. So it ripped right through my longer term trade and it ripped through 2 of my should have known better Fed Day trades. Because I think this first trade right here, let me zoom in a little bit to that particular time. So here, yeah, I thought, and this is typical, this is so typical, right? So at the time, I'm looking at Fed Day here, right? So this is the announcement of the rate. I think they announced the rate was going to stay the same or whatever, but they still didn't like it for whatever reason. But the market started to dip, but it didn't really dip like crazy or anything like that. And I felt like I was going to jump in a little bit early and see if I could catch it because it was oscillating, going down and going up and going down. I thought I was going to oscillate one more time and give me a little wiggle room. So I entered a trade right at what I felt was the bottom of the oscillation because I saw this bottom. I was like, oh, that's a double bottom. Boom, boom, boom. The stochastics were looking fine. We're below the 20 line. Everything's kind of lining up for an oversold scenario. And then the next candle, boom, right? So of course I'm pissed. Like, and it gets so much better because you're doing this in public for me, right? You're doing this with eyes on you. So nothing makes you feel more retarded and more like a fraud when something like this happens. But that's life. That's the market for you, right? You just take your chance and you have to run with it and eat the consequences sometimes. So, of course, the Illuminati saw that, even I could place a trade. They wanted to make me feel as stupid as possible. So they decided to actually tank right soon as I put in my trade. So of course the market did what it did, and I got stopped out probably right here on this candle, I would assume. Um, so of course, what did I do? I'm feeling all kinds of ways at that moment. So what do? I revenge trade, right? And in my head, I'm not thinking, oh, I need to get revenge or anything like that. But I'm like, in my head, I'm like, oh, I can't waste this juicy drop right here, right? So this is a juicy, super juicy drop. The VIX is exploding. We're getting some good numbers as far as like puts where we could get a nice deep put trade on for the next day, and believe this is like an overreaction because this is kind of crazy, right? But it's Fed day. Fed days are just crazy. They're allowed to be crazy. They're Fed day, right? I wasn't thinking about all that. I'm just thinking about how juicy this drop is and how juicy the VIX is and how juicy these next day puts are going to be. So of course I place what I deem a roll. And luckily for me, this was not a full trade. Neither was this. This was not a full, this was like a toe dip, like a couple of contracts, not a full, like my normal full trade. So that kind of saved me a little bit right there. But I try to save the trade and roll it down right here. And it got rolled to this level right here. So the market went from entering our first trade at 44.33 to now hoping the market stays above 43.55. So we're talking about more than 100 points. And the market had been trading within like 30 points a day up until that point, right? So the next day opens and we get destroyed, absolutely destroyed. And I think I tried to wait it out to see, it's a huge gap. So of course I'm thinking gap fill, whatever I'm thinking. And then it just doesn't happen. Just doesn't happen. So I finally just call it quits and pull the plug. Right. So those are my losses. Luckily, they weren't full trades, so they didn't hurt that badly, but basically 3 losses basically on the same 2 days. So that sucked. But we still got all this blue. That didn't deter me. I think I might have taken like a day off or something like that to recover mentally right here, just to kind of get a read on the market. But after that, we were good, and the market was still dropping. Even though the market was still dropping, we were staying ahead of it. Like this trade right here. You zoom in a little bit. So, the next day we're putting in this trade right here. See this big old drop, thinking the drop is going to slow down. So we got in, kept dropping a little bit, but it did end up reversing. So we got a nice little 1 DTE right here. Got a nice little iron condor going on the same day. And one thing that I want to look for when I'm doing these iron condors this way is I'm trying to get separation. Sometimes it's not easy to do, but if I put in a put spread, say 43.31, I want to put in a call spread higher than that so I can get a nice little gap between where I enter my put and where I enter my call. So sometimes it's not easy to identify, but we were a little bit successful here. We got a little bit of a spread between this put and this call. Here we got some separation, even though it's on 2 separate days. Still, we got some separation here. You can see how late in the day I put in this trade for this call spread. Put spreads right here. We got some 0 DTE and a 1 DTE going on at the same day. So that was fine. So all of these trades worked out. This got a little bit hairy, but again, you can see the curvature, right? So even though the market was pressing us at the time that we put in the trade and the market was pressing us the next day, still, I didn't get stopped out. And I could see it visually right here. It was pressing on us, but it ended up backing off and never stopped us out. So you can see that curvature at work. The market was pressing us on this trade too, right? We entered it, and then the market exploded on us a little bit early on in the trade, but then it kind of left us alone. It gapped up on us still, but still left us alone and left us to our nice little expiration as far as that's concerned, right? So we got pressed again on this trade. This wasn't fun either, but still no stop out. Had my stop on nice and strong. So the next bout of trouble we got in was right here where I actually did get stopped out. But we just, put on another trade, rolled it up, and I guess we got zeroed out. I really can't remember on this one, but I think we just zeroed it out, and it was not a profit, not a loss at the end of the day. So we have that going on. And then later on towards this time frame, this is when I went to a monthly trade for my long termers to kind of take a look at and participate in. So this is a long-term trade right here. The thicker blue and green line. This was like a 30 or 45 days out or something like that. I don't know. Something like that, yeah. So you can see that doesn't expire until whatever day this is. But we've been pretty good. The next bout of trouble that I ran into really was right here. And this wasn't, I don't think this was on any news. I think we just got some disappointing earnings or something like that during this time frame. But I had a 1 DTE, entered it kind of midday. And again, guess what happens? We enter it and then the market drops right on our heads. Never fun, but it seems to be a reoccurring thing. But we ended up getting stopped out on this particular bar right here. And I started marking the bar that we get crushed on. So that little, I don't know if you can see that little mad face right there, but it was this long bar. Stopped us out of our 1 DTE. So I decided to go ahead and roll it. I think I talked about this already, but went ahead and rolled it. And that roll, we put it out maybe like 3 days ahead just so it can get to the level that I wanted. And the roll ended up being successful. It sucked waiting. I'm not going to lie. It sucks waiting this time to get this money back in the account. It really does suck, but, it's better to have it back than not. And I guess my thought process here was it's going to take me about 3 days to trade to earn the loss on this particular trade back anyway. So instead of actively having to work to do it, I might as well just pop the trade that I want out here anyway, and just let the market do the work for me over that particular time. And, it worked out. Maybe in another situation it wouldn't have worked out, but I felt like the market was kind of oversold anyway. So there. So we got a win off of the roll. All the other trades working out just fine. And what's crazy about the long-term trade that I have on, right, is, excuse the noise in the background. I've got family over playing games and stuff. What's crazy about this long-term trade is the long-term trade has been in trouble on both. Oh, I don't want this green, but yeah, it's been on trouble on both sides. So what I did is, you see this blue thick bar right here. This is our longer term trade. So our put started to get in trouble, or not in trouble, but like started to inflate a little bit. So what I did is I rolled down the call side of it. So that's why this is green, because I closed it out for a profit. Rolled it down to here. So now this is our call side of our long-term iron condor, because I wanted to zero out the deltas a little bit, or flatten out the deltas a little bit. And now the call side is starting to get pressure because the market just reversed on us and, did its thing, right? And it looks like after today's Fed meeting, it's going to continue to move in that direction. So I got to figure out if I'm going to now roll up the put side of the long-term call spread and see what I'm going to do, if I'm going to do anything about the long-term call here. So that's decisions yet to come. But I just found that interesting how the market just likes to ping pong all over the place, and you just, 1 second one side's in trouble, the other second the whole other side is in trouble. So it's just the interesting dynamic there. But that's our September and October. Um, as far as profitability goes, I've kind of been stuck in the mud because of some stupid trades, like this stupid trade, series of trades right here, kind of set me back a couple of days. I probably wasn't whole on these trades until maybe this point somewhere in here, and then I took another L, well, temporary L, because this is just now successful as of yesterday, but a temporary L on this trade because this roll was a full trade, right? So this was kind of a temporary time wise setback. Now I'm made whole on this, so I'm kind of where I was maybe back here as far as profitability. So it took all of this time right here to make up for this junk right here, right? Now, these, like I said, weren't full, most of these weren't full trades or anything like that, but still the severity of the loss, like how deep these losses were because I wasn't doing stops, still caused a lot of havoc in my account. So even though the contract size wasn't large, the individual contracts losses were large. So it really set me back, where this trade being stopped out, even though the contract size was large, the loss amount per contract was not large. And this was a much better scenario than dealing with, that stuff back there. So this really did feel like just kind of like a hiccup. Even though it was annoying to have to wait to get the money back, annoying is better than like, oh my God, I really jacked my account up. So again, with the stops, right? That's why I keep my stop armor on me, because it's just much easier to deal with a stopped out trade than it is, a catastrophic trade. So I'd rather deal with 10 stop outs than one catastrophic, mess up at this point. So that's my October and September. And and I avoided Fed Day, so I probably would have been fine, honestly. But I still avoided Fed Day, so I don't even have the thought of I could have messed up or something like that on Fed Day. Don't even have to worry about it or think about it. So off into the future. Here's to a successful November, December. Let's close out the year and see where we end up. And we'll see you next time. Have a good one.